time for viewer mail. But we don't have viewer mail this time.
We don't have viewer mail.
So send it in.
Send it in, please. So I'd rather answer your questions than mine. Send it to Doug@riskandrewardtv.org, and I would be happy to answer your questions. But I know what they're thinking this week. Everybody knows what they're thinking.
What?
The LinkedIn IPO hit and skyrocketed the first day, doubled over the offering price, the IPO price, and everybody's like, ooh, IPO fever, we got to get in, we got to make some of that fast money. So the question this week, of course, is should you buy shares in the LinkedIn IPO or in any future IPO, really? And that's really the big question.
So show them what has happened with LinkedIn.
So here's the chart. Here's the this is Yahoo Finance, Google Finance, Algam, the same. So it came. The IPO shares were priced at 45, and then it took a little dive, and then it skyrocketed to almost $120 a share in the first few hours, and then since then it's dwindled off that down, and it was down a little bit today. So the price today was 93, and the high price was 122.70. So it's down quite a bit from the peak the first day.
But right now, if Apple's had the same valuation, Apple would be worth $3 trillion.
$3 trillion, yeah, which no company's worth anywhere close to that. So it's not valued.
Kind of sounds like a .com boom, and
it's certainly been hyped quite a bit. You know, you can't get into the Twitter, you can't get into Facebook, you can't get into some of the other hot companies that you just want to get into. So this is the one you can get into, so everybody piled in. So, you know, when you think about valuing a company in finance jargon, you think about fundamental analysis, and the value of the future cash flows of the company are what you're really buying.
Are they making money?
Well, they are making money, but they're not making very much money, which is why if you put the multiple that they have against Apple, Apple comes to $3 trillion, which is ridiculous. Mm-hmm. So the problem is you don't know what the future cash flows of LinkedIn will be. Now, we should talk a little bit about how an IPO works. So an IPO, initial public offering, company starts, usually the founder starts it in his garage or something, gets some angel capital from friends and family. Angel investors come in with, you know, low amounts of capital to get it going. Then you get some venture capitalists that start buying it. It keeps going up in value as the company gets bigger and bigger and bigger, and eventually it hits the IPO price. Now, the way the IPO typically works, although this is not always the case, is a brokerage firm, an investment bank basically, will take a company and say, we're going to take you public, which means we're going to offer a block of shares to the public, and it'll do what's called a roadshow, and it'll go out to all the investors, the main investors, and say, we're going to offer shares of LinkedIn, and we're thinking about a price of, say, $35 to $38.
And that's supposed to be a fair price.
They're supposed to come out with a fair price that they've had some justification on the numbers. And so they do this in the numbers, and they try to convince the investment community that this is about a reasonable price, so this is what we should sell it for in the initial public offering. So, but they want to leave a little room in there for them to make some profit. So they don't want to price it 100% of what the company should go for, because on the first day then it could fall, and the people who bought it would lose money. So they want a little gap in there. Well, today's gap was $45 IPO and $120 in the first 2 hours, so that's a pretty big gap. And of course, in the dot-com era, this was happening all the time. So if you're on the inside and you get the IPO price at $45 and you're a highfalutin client of, I don't know, JP Morgan, Goldman Sachs, somebody, and they say, I'll give you 1,000 shares of LinkedIn at the IPO price. Well, you bought it at $45. And they take the money out of your account, put the shares in your account, the opening of trading. Then the first trade is in the secondary market. The first trade at this was, I think, $80 or somewhere around $80. And so the first trade was $80. The IPO price was the initial price. Then the first trade was $80 in the secondary market. So the first guy who took his $45 shares and stole them at $80 made an instant profit.
He's made the money.
Well, he makes money, and everybody got the IPO made money, or makes money so far if they're still holding on to it. And then it goes up to 120, and you could have sold out then and made even more money. So the IPO, if you're on the inside, is great. If you're on the outside in the secondary market, did you buy it at 80 and get out at 120? Well, that's huge.
And you would have had to do that within a very short amount of time.
Very short amount of time. Or did you buy it at 120 and get out at 90? Which is a big loss. That's right. So it's very risky. The volatility is definitely the risk. And so there's a couple reasons why firms do these IPOs. One is to get capital into the firm. They issued enough shares to bring in $400 million. So they sold shares, pieces of paper, parts of the company, and they brought in $400 million that they get to now invest in software. I don't know what LinkedIn's going to do with $400 million, probably advertising or some sort of development, but that's one reason. The second reason is the people that own the shares, the venture capitalists, angel investors, and so on, well, they want to sell, and they got no one to sell to unless they sell to the public. So if you had shares of LinkedIn or Facebook or someone, and you had them tied up in your stock options and so on, you want to sell them, you want to go public because then you've got this big secondary market.
Take your money and run.
Yeah, so you
keep
can
a few shares there.
Well, maybe, but you definitely have an option to sell in a public market if you go public. So there's two reasons: one, to bring capital into the firm, and the second one is to get the people in the firm out.
Now, what about the Blackstone Group?
Well, the Blackstone Group is an example of somebody who may have just been trying to get their capital out. I'm not that's alleged. I'm not saying that they did, but the Blackstone Group went public in 2007, right before the crisis.
The crash.
Right before the crisis, and they had a lot of credit that they were using to the credit derivative swaps and so on to make money, and that came to an end right after they went public. And so they had a $4.1 billion IPO at $31 a share. Now it's about $16 a share. And of the $4.1 billion, the two guys that started it, or that were on top, ended up with about $2.6 billion.
Nice payday.
Nice payday if you can get it. So, now they're being sued, and it's a big scandal, and I don't know exactly what happened. I'm not saying it did, but there are companies and there are people.
There's a lot of people that are upset.
That they're upset that they brought on public with this and didn't disclose. They say they didn't disclose, but they did disclose some things. I mean, you don't have to look very deep into their information to say, hey, this is risky, and markets can change, and we can have bad years. So anyway, the point is, there's a lot of risks in IPOs, and if you looked at LinkedIn, as you said, if it was Apple, it'd be worth $3 trillion, but it's worth a lot of companies that are much bigger than that.
Yeah, right now LinkedIn is valued higher than Hyatt Hotels, Electronic Arts, Seagate Technology, Expedia, Tiffany's,
Chipotle. They make burritos all over the place.
Is LinkedIn worth more than those companies?
Well, that's a good question. So it's valued more in the market today. So is that a buy or sell? I certainly am not giving you advice on that, but I am suggesting that IPOs in the secondary market are risky.
And what's your takeaway?
So that's my takeaway. IPOs are an insider's game. So if you're on the inside, hey, that's great. If not, it's pretty risky. And more often than not, the rewards are not going to be worth the risk. Just because a company offers shares for sale doesn't mean you should buy.